Well, the oil cap is well below where the European price is. It's above where Asian prices are, but they don't matter much in terms of the oil caps. So for all practical purposes, the oil cap is irrelevant by a good $8 to $10 a barrel. We have a cap at 60, and most seaborne crude, which is what this is all about, going into the West from Russia, is in the $50 range. So there won't be any impact unless Moscow goes ahead with its threat and says, we're not going to export X amount for whatever reason. But so far, we don't think that's going to happen. The market has not moved a lot. The market has been moving for reasons other than what's happened over the weekend. The market's been moving because of optimism about China opening and concerns about the U.S. dollar because the Fed might be reducing the pace at which it's raising rates. Both of those may be iffy, by the way. So I think we're going to have the same kind of volatility in the market that we've had, through the fourth quarter. We'll find out that China is not going to be rebounding in terms of demand until sometime after the first quarter is over. And we'll find out probably that given the other thing that the Fed reads, namely the pace of growth in the U.S. economy, that they're going to not relent on raising rates. So we'll see what happens. But I think volatility is what we should expect rather than a continuing rise in prices.
Edward, just talk us through very quickly, if you could, the mechanics of this supposed price cap. As you've already said, it's almost irrelevant in terms of actual trading practice. So it's, the politics around it and the reason why they're even putting it on is questionable in itself. But even if it was more relevant in terms of its actual impact on pricing, how does it work? How is it expected to work? From what I understand, the US is just threatening to punish anybody who doesn't agree with its position on this. But is that likely to actually be effective? And what is Russia going to do? I mean, all Russia has to do is say, OK, we're not going to take that price.
So first of all, it's not just a U.S. issue. It's a G7 issue. And it really is European-based because the issue had to do with Europe per se.
Let's be entirely honest. It's a U.S. issue. The U.S. is driving this sanctions policy. The U.S.'s political imperatives are what drives this market.
I actually don't agree with you on that. I think it's a mutual concern, and the European angle on it had to do with getting a price level such that insurance could still be issued, such that the brokerage in Europe could still work. So I take exception to that. Yes, the U.S. is massively behind it, but so are some other European countries. I think Poland has a much more radical position than even the U.S. on this issue. But it can't work, and that's the problem behind the whole concept. It can't work for all kinds of practical reasons. It can't work because there's too much ways to escape it. It can't work because there's no way to monitor exactly what the price is. It can't work because there's no way to stop a blending of Russian crude with other crudes, and that can come in at a price that's above the price cap level. So I think it was not a wise decision since it can't be monitored and since it still has the liability around it that the Russians may say, you have the price cap on, we're not going to play, we're going to reduce our exports, and the price will get higher.